When investors start hearing dire predictions about a possible recession, the bond portion of their portfolios can take an increasing importance. The bond market, or fixed income market as it's known in the industry, typically is viewed as a rather staid and boring aspect of investing. When market volatility increases, however, it's easy to panic, especially if your portfolio isn't diversified on the bond side. Interestingly, market researchers at Avantis Investors have studied how different types of bonds have performed under different conditions going back some 50 years or more. Today, we're fortunate to have Phil McInnis to talk about this issue. Phil is Chief Investment Strategist at Avantis. Before joining Avantis in 2019, he was a Vice President and Head of Portfolio Solutions at Dimensional Fund Advisors. Hi, Phil. Thanks for joining us today.
Hi, Murray. Thanks for having me.
You betcha. The most striking set of data that you folks uncovered in looking at past recessions going back to the early 1970s was how different U.S. Treasury bonds have acted during such times of market stress as compared to U.S. corporate bonds. Can you explain some of your findings?
Sure. Yeah, absolutely. And it is something that, at first, I think maybe people group all sorts of bonds together, right? Because they are seen as being less risky, right? A little bit safer than, say, equities, right? And you and I have spoken about some of the research we've done there in the past, looking at how stocks have performed at different points in time throughout history. So when you think about treasuries versus corporates, I think there's something to keep in mind there, right? Of treasuries having that full faith and credit of the U.S. government behind it. And if investors hear the term flight to safety or flight to quality, a lot of times what folks are talking about is people going in and flocking to something like treasury bonds. So what we observe is that if you think about those more recessionary periods back in time versus expansionary periods, what you see is that treasuries tend to do a fair bit better in the earlier parts of those recessionary times than corporate bonds do. If you sort of flip that and you say, okay, if we kind of again split recessions in half, not just looking at the full recessionary period, but start splitting it in half, you see some different results, which we can probably speak a little bit further about.
Yeah, and it's interesting because treasuries don't only outperform during the start of recessions, the first half of recessions, but they are strongly positive, whereas corporate bonds have slipped in the past on average a good deal. Not as much as stocks, of course, but they still fall into the red category.
Right. Yeah. If we think about that initial downturn, right, that initial downturn that you see, if NBER goes back and classifies a recession, if we look from sort of that peak down halfway to that eventual trough that they've identified, stocks, less than sort of 2% per month, or I should say more than 2% down per month, right? Whereas with corporate bonds, you see them being slightly negative, around a 0.25% negative per month, whereas you actually see treasuries being positive, almost more than 75 basis points positive per month in that time frame. So certainly some big dispersion.
Yeah. So when you need it the most, treasuries tend to support your portfolio, whereas corporates don't necessarily do that.
Yeah, with corporates, again, I think it's all relative, right? So relative to stocks, we've certainly seen them hold up better, right? And that's what you would imagine given the way the capital structure works.
Mm-hmm.
But all that said, you are taking on a little bit more, credit risk, not just getting the full faith and credit of the U.S. government. Again, you've got a specific corporation that's issued a bond, and so your investors are trying to determine if you have any kind of economic downturn or anything else, how's it going to affect this individual company and their ability to meet their credit requirements.
Sure. And and by NBR, you're talking about, what was the acronym?
Sure. NBER, the National Bureau of Economic Research. Sorry, I used a lot of acronyms. So they're the ones who actually go back and say, here's when the U.S. economy actually officially entered a recession, and here's when it officially ended. So they're the quote unquote scorekeepers for the book of record.
Yeah, you write in your research The data show that U.S. corporates have historically exhibited similar patterns to equities throughout past business cycles. Like stocks, the weakest returns for corporates have come during the first half of recessions, followed by strong returns in the second half. And as true for stocks, above average returns for corporates have also historically carried into the first half of expansions. After that, I guess, corporates with their increased risks and lower credit quality compared to treasuries are more stock-like in their returns, although that's kind of far-fetched.
Yeah, they're again, they sort of fall in between. I think if you go back and you look in time and the research that we were looking at investment grade quality corporate bonds, right? So those range from AAA rated down to BBB rated. That's what's considered an investment grade by the ratings agencies. And so when you think about the long-term sort of default rates that are observed among those corporate issuers, they tend to be pretty low. You're talking about less than probably 0.5%, which among, again, investment grade issuers. So that's a pretty low percentage. But obviously, relative to treasuries, you are seen to be taking on more credit risk, and that's where that expected premium comes from. And so I think any time when you think about what's going on in markets, as they are forward-looking, right, they're trying to assess what's going on today and what do we expect to happen in the future, and how is that sort of calculus impacting what I'm willing to pay for a security today, or sort of what's the expected return I need to earn to be willing to hold it. So you have multiple things that are impacting, basically an investor's propensity or willingness to take risk, along with the overall expectations for how these companies are going to do in the future, right? Those are part of what's impacting the prices that folks are willing to pay. And so it's sort of natural, or it makes some sense that if people are concerned about the future and you see markets reacting negatively and prices going down, that anything that's deemed to be a little bit riskier will be falling in price more than something that's deemed to be a little bit safer, like treasuries. But just sort of the opposite is also true. So once those concerns start to ebb a little bit, right, and people say, okay, I don't think this is going to be maybe as serious as we would have thought, or we think there's more health coming back in, and you start to see prices adjust the other way, what do you see? You see corporate bonds, you see stocks actually doing significantly better than their long-term averages in that second half of the recessionary period, and better than treasuries as also. So it kind of goes back to me of, this is that idea of a diversified portfolio, right? You want some allocation to stocks, you want some allocation to treasury bonds, you want some allocation to corporate bonds. All those can work together inside of a portfolio for you.
Yeah, and you write, the risk for investors now considering jumping out of fixed income or shifting weight from corporates in favor of treasuries is missing out on the higher returns historically seen for corporates in the later stages of recessions, when the market begins to incorporate better news into prices and the recovery begins.
That's right. I think if we look, where you're sitting in November, year-to-date period has been pretty painful for fixed income in general, right? I think a lot of investors may not be used to seeing those types of returns inside the fixed income portion of their portfolio, where you have, bonds kind of in general. If you look at something like the aggregate bond index, down 15-ish%, right? That's a pretty big drop for somebody to look at in the what's supposedly more the safer part of their portfolio, right? So it's natural to sort of have some concerns there. The other thing that you've had going on is you've actually seen that yield curve inversion, right? Something that people have probably read about in the press, the idea that shorter term interest rates are actually higher for treasuries than some of the longer term interest rates. Typically what you see is that upwardly sloped yield curve, where the longer term yields are higher than those shorter term yields. We've actually seen that reverse. And so people are looking at it and saying, am I getting any benefit from sort of extending out, right? Extending out away from that shorter term debt. They see the higher yields in shorter term treasuries, and it's why would I want to own anything else? And so again, it's natural for people to have these reactions, but if you start looking and you compare a treasury yield curve relative to, say, a corporate yield curve, we actually see that those corporate yield curves are still upwardly sloped, so to speak. So the longer term yields are higher than those shorter term yields. And that gets into this idea where if I've sort of felt the pain in my fixed income portfolio of seeing those prices go down and seeing, kind of negative returns on a statement, well, if I sell out, what am I doing? I'm really just locking in that loss, right? If we look at, though, and we think about expected returns based on the price today, expected returns are reasonably high. So that gets back to us for not really wanting to make huge shifts in an allocation. You probably want to think about, why did I hold this last week, last month, 6 months ago? And it's probably still going to be reasonably appropriate for today, unless something big has changed in your circumstances. Because otherwise, what we're doing is we're kind of giving into that pain, selling out and locking in a loss, as opposed to hopefully being able to reap some of those benefits as what we all hope, right? Things are going to get back to normal. We're going to start to see more economic growth and less downside price pressure.
Sure. So trying to time markets in bonds is as fruitless as trying to time markets in stocks.
With all of it, what I think about is that, again, that long-term asset allocation that you've likely worked with your advisor on. There's a reason it was good for you, 6 months ago, a year ago. It's in the context of that financial plan, and so making big shifts in and out of it, you're more likely, I think, to be disappointed with the results of that, as opposed to surprised, or positively surprised, I should say.
Yeah. And well, thanks for your time today, Phil.
Thank you, Murray. Always a pleasure to be here.